Okay.
Yes.
Okay.
Yeah. So
Shall
we?
Yes.
Yeah. Okay. Well, welcome back, friends, to today's conference. Today we have a special guest, as usual. Of course, it could not be otherwise, since we are celebrating the contribution, the wonderful contribution of Professors Tony Thirlwall to development economics. And as well, we are also commemorating the 80th anniversary of our main journal, Investigación, Económica. So welcome to today's conference. It is with great pleasure that I welcome to our seminar a friend of mine, Professor Carmen Feijo. Professor Carmen Feijo got her PhD in economics at the University College London in 1988. She has occupied several positions in the Brazilian Academy. She was elected Executive Secretary of the National Association of Postgraduate Programs in Economics for the 2008 and 2009 period. In September 2011, she was nominated as the representative for the area of economics at Páez, a governmental agency in charge of evaluating all postgraduate programs in Brazil. Currently, she is a member of the CNPq Economics Advisory Committee. Besides, from 2015 to 2020, she was the editor of the Cadernos do Desenvolvimento at the Celso Furtado International Center. Since 1992, Professor Carmen Feijo is a professor at the Fluminense Federal University in Brazil. She worked as a researcher at the Brazilian Institute of Geography and Statistics until 2003. She has experience in the field of economics with an emphasis in post-Keynesian macroeconomics and development economics. She has written prolifically on various topics related to economic theory, heterodox economic theory, the economics of the Brazilian and of Brazil. And her most recent article, to the best of my knowledge, and it wouldn't surprise me whether Carmen has produced further papers after she submitted the one that she's going to present today. So her most recent article, and why she is with us today, is the Brazilian investment cycle, financial fragility of the industrial sector, a paper that will be published in Investigación Económica in the coming issue. So, Professor Carmen Feijo, many thanks for joining us in this seminar. Thank you very much, and the floor is yours. So we will work out as follows. You will speak to say 50 minutes to 1 hour about that, and then we will have a Q&A session from the public. Thank you very much, and please go ahead. The mic is yours.
Okay, so thank you very much for the invitation. It's a pleasure to be in the seminar, and it's an honor to be in this commemoration of the anniversary of the Investigación Económica, such a remarkable journal, an important one for us in economics and in pluralism. So thank you very much for this invitation. As Ignacio has already mentioned, I'm going to present a paper that's, yes, this is my last paper. I don't have another one, but I'm working a few. Actually, I have a few, yes, I have another one that I will mention in this presentation as well, but it was being developed before. But so I have a PowerPoint to share. I think I will share my screen now. I try to do it. Let's see if it works. And then it will be easier to follow the presentation. Yes, I think it's here. So everyone can see
Yes.
the, yes, so
Yes,
it's,
we do.
so yes, so yes, thank you very much once again. The paper I'm going to present is the Brazil investment cycle, financial fragility of the industrial sector. It's co-authored with two colleagues of mine, Marcos Lamonic, Sergiane Lima. And also, as I mentioned, I will try to update the discussion on financial fragility of non-financial firms, bring data from another work that was developed with two students of mine, Eduardo Mantuan and Vinicius Centeno, for the top largest non-financial firms in Brazil. So I will illustrate my points with this sort of data as well. So I will start putting my main point is that the Brazilian economy has shown low resilience to grow since the 2015-2016 recession. So if you look at the graph, at this, we'll see, I put the GDP growth rates from 2003 to 2019, so before the pandemic. And we can see that we have this decrease in GDP in 2015-2016, a sharp drop 2 years in sequence. And what comes the following years, we do not have a recovery of that deep recession in 2015-2016. So in 2019, GDP did not recuperate the 2014 level. Not only we have observed the shrinking of GDP, but also it's what is very deep, it's new in our economic history. It occurred without a balance of payment crisis. Looking at the investment rates, the investment rate was around 20% in 2014, and in 2019 it was 15%. So the poor recent growth performance of the Brazilian economy shows the difficulty of resuming the investment rate, and as I will point out, the failure of austerity policies. So moving on, I have two main points in this presentation to show that the Brazilian economy was in ascending phase of an investment cycle. What happens that the change in the external environment after the international financial crisis in 2008 and the change in economic policy orientation from 2011 onwards impact the balance sheet of industrial firms in a very negative way. So here in this graph, I put the annual growth rate of gross fixed capital. And the dot line is a trend line. So just to illustrate this idea that we were in a investment cycle. We start in ascending phase in the mid-2000s, and then enter 2010, we start the descending phase until 2015, when we dive into this recession. Also, I will show the evolution of balance sheet of largest non-financial firms after 2015. I hope I can update a little bit the information I'm bringing in this presentation. So the outline of the presentation, I will very briefly point out Minsky's financial fragility hypothesis, because that is the theoretical reference of the paper. Then I will present a discussion about the evolution of the Brazilian economy in the 2010s. emphasizing the behavior of the capital formation in a context of reduced aggregate demand prospects. I will investigate the evolution of a financial fragility of the industrial firms. Actually, here I'm going to use annual industrial survey data to build a financial fragility index. And then next, I'm going to present the results of an econometric estimation of the determinants of the financial fragility. So in order to bring more information, I will investigate the behavior of the largest non-financial firms, balance sheet. Here, the evidence will be drawn from the balance sheet of the firms and how did they react to the contraction of the economy. And then I'll have a final consideration. So starting with Minsky's financial fragility hypothesis, I like that expression that he used, that modern economies are like paper worlds. He defines a paper world. His word means that the viability of this paper world rests upon the cash flows or gross profits after out-of-pocket costs and taxes that business organizations, households, and governmental bodies receive as a result of the income generation process. So paper world implies that the presence of financial assets that can meet both the criteria of offering profitability and liquidity, and thus reducing the degree of uncertainty involved in the process of accumulation of capital in fixed assets. Actually, Minsky's financial fragility hypothesis means that moments of stability, they are followed by economic turbulence. They are recurrent in modern economies, and this is the result of the tendency of market economies to expand based on increasing indebtedness. And because of that, you raise the possibility that it's difficult, that in certain moments, there is a difficulty that different economic units have to fulfill their past obligations. So the financial fragility hypothesis, Minsky develops it, showing the interaction among economic agents, in particular, to show the importance of the financial system. The decision to commit to large financial resources for long periods depends on the financial firm's decision to expand financing to meet the demand for capital goods or roll over the accumulated debt. When demand is growing, agents can count on the expected income to cover the debt commitments. They can also rely on external finance through the issues of shares or sales of assets, or simply through financial loans granted by banks and other financial institutions. But once you have a deterioration of expectations, this will point out toward a reduction in the supply of new loans and the raising of interest rates. So you have the upward phase of the business cycles that can be described as the one in which economic units move from more conservative postures in their balance sheets to more speculative postures. Once financial conditions change, more in-depth units face more difficult rolling over the past commitments, and the reverse of this pensionary phase is observed. So that's my last about Minsky. The financial fragility hypothesis and the business cycles, so we can describe boom periods that translate into an expansion of the balance sheets of financial and non-financial firms, and periods of recession translate into the shrinking of the balance sheets. This movement in the leverage of firms in its turn generates instability in the whole economy, which is translated according to the availability of credit into the economic activity. So in Minsky's view, the contraction of credit has a medium-term or more permanent negative impact on the growth trajectory of the economy through the contraction of the investment fixed capital and the loss of human capital. So moving to the next point, I will discuss the performance of the Brazilian, this investment cycle, and I will divide in two periods. The first period is the one when the macroeconomic, what's known as the macroeconomic tripod is consolidated. That's a macroeconomic policy arrangement that's based on flexible exchange rate, inflation targets, and primary fiscal surplus. But that management of that policy was on a very conservative way, which result in relatively high level of nominal and real interest rates, an appreciation trend of the real exchange rate that we know that induce the substitution of domestic goods for import goods and led to the process of the industrialization. But during the 2000s, domestic demand expanded, fueled by the increase in real minimum wage, increase in employment wage, and supply of consumer credit, and as I will show also in public investment, and also external demands with the improvement on the terms of trade from 2003 on. But from 2011 you have a change in domestic policy because you had the perception that the recovery of the world economy after the 2008 financial crisis would be slow. And that implied a shift in our macroeconomic policy that became to know as the new macroeconomic matrix, that was an attempt to turn more flexible the macroeconomic tripod. And also, that's important to note that policies, macroeconomic policies, they move from the incentives on aggregate demand to incentives to supply side types. Also, and on the top of that, to have the deterioration on the terms of trade from 2012 onwards, and the deceleration of domestic growth, and this end up with the deep recession, 2015-2016, and of course, investment rates dropping steadily. So here, just to illustrate with the growth rates of GDP and capital formation, in these two periods, 2000-2010, GDP growth rate was in average 3.7%, and gross capital formation increase in average 5%. And next, 2011-2019, you'll have GDP in average below 1% and negative growth for investment. Looking specifically to the rate of investment start to decelerate from 2013 onwards. And so an interpretation is that since mid-2000s, a favorable scenario was building up, was set up, and that allowed for an spontaneous optimism to emerge. However, we have the sudden change of the external scenario in 2008, and then and this perspective of a long-lasting world recession, and that in line with Minsky's description of the business cycle, it hurt business expectations, and that's when we should expect to see that firms' financial balance sheet should deteriorate, and policy space was much reduced in our case. So here, what I have is a graph for investment, and I have two curves. The dotted line is the investment rate, so is the share of gross fixed capital formation to GDP, and the line above is the share of public investment to GDP. And so I would like to highlight that you have this increase in investment rate starting from the mid-2000s, and that is the result, or as I see, of that the building up of that optimistic expectations in the potential growth rate of the Brazilian economy, and directly related to the improvement in terms of trade and the expansion of the exports and also domestic markets. And when you have this drop here, it's in 2009, what we observe is 2010, a very steady recuperation, a recovery. And looking at the curve that's above, that shows the public investment, so public investment continued to grow until 2010. And that was an attempt by the government to sustain aggregate demand, the decrease, to compensate the decrease in aggregate demand because of the external shock of the 2008 financial crisis that hit the Brazilian economy with a decrease in GDP in 2009, but a very rapid recovery in 2010. So it showed that the recuperation in 2010, it was a good response to the stimulus of the aggregate, of the sustain, of economic policy sustaining aggregate demand. So the investment rate was kept around 8% until 2013. But what happens is that domestic conditions to finance long-term investment, they were very different from what the period before 2008. So the scenario, the macroeconomic scenario had changed. And you start decreasing the investment rate. In 2013, you see a deceleration and the public investment in 2014. So in this graph, what I compare is the volume of investment and the credit operations of non-financial firms. And what I want to highlight is that the evolution of both curves, they show the critical moments, as I say, when a growing number of firms might have been disappointed in their revenue expectations compared with their debt commitments, when the investment start to decline and you still have to contract credits, perhaps to renegotiate past debts, because the macroeconomic scenario, the growth prospects, they have changed. from 2013 onwards. Here is to illustrate what happened to the interest rate. So, as I said, the macroeconomic policy has been conducted in a very conservative way. And so here I plot the real interest rates, and I've highlight the average in 2 periods. From 1999 to 2009, the average real interest rate was 9.3%. And from 2010 to 2019, this average is 4%. So both averages are very high. And of course, they have been declining. So, but still, they are very high interest rates. And what I point out here in that red circle is what happened from 2011 to 2016, that you have a sharp drop at first in the interest rate. That was the attempt of the government to turn more flexible the macroeconomic tripod, so to drop the interest rate, but then inflation expectations start to increase, and so immediately you have again a sharp increase in the interest rates. So just to illustrate, the basic interest rate started to be increased in 2012. It moved from 7.25% a year to 13.75% in 2016. So let's, and now from the fiscal policy, also fiscal space was much reduced in the 2010, because let's recall, the government moved the kind of incentives, fiscal incentives, and now the expansionary fiscal policy is composed of tax exemptions for household consumption and firms in several sectors. And actually, this sort of stimulus, they show little effectiveness in reactivating economic activity. And let's remind that public investment has been cut, starting being cut from 2014 onwards. Also, I consider that it should be mentioned that in 2014, we started that the Operation Car Wash that investigates, among other things, the biggest company in Brazil, Petrobras, and also the impact of that operation was greatly negative. It had a great negative impact on the business sector. In 2015, the economy was facing several problems, such as increasing of inflation expectations and a dramatic drop in domestic aggregate demand, especially private investment. Public investment had already dropped, leading to the deepest and longest lasting recession since the World War II. So here for the domestic factors that led to this contraction. So summing up our interpretation up to now, we started the 2008, the international financial crisis, and its long unfolding in the following years increased the financial fragility of firms, as domestic macroeconomic scenario also deteriorated. So I was in an ascending phase of the investment cycle, and that phase was interrupted by the international financial crisis and the changes in the domestic macroeconomic scenario. From 2013 to 2015, that's the first year of the recession, the real exchange rate devaluated 24%. The economic measures taken in 2012 onwards to boost private investment that based on fiscal incentives showed little efficacy because they did not reverse business expectations. And from 2013 on, public investments start to decline. The domestic macroeconomic indicators, public debt and inflation were worse off, contributing then to blurring the economic prospects. Of course, again, from 2015, we enter a recessive phase. Some authors consider that Brazilian economy actually is in a depression, not in a recession, exactly because it shows that low resilience to growth. So moving for my third point, now I'm going to develop on that financial fragility index that's in the paper. We are now looking to the industrial sector. And so actually the financial fragility index, it will refer to industrial sectors, not to industrial firms, actually, because the database is the annual industrial survey. So we base on the composition. Basically, this index, it's built comparing the receipts and costs and expenditures, and then we propose that financial fragility index, following Minsky's definition of gross income. We work with 25 sectors of activity, and then the financial fragility indicates the amount of cash that firms dispose to face duties and debt commitments. As we look at sectors, we have an information about the average of the firms inside each sector. So here is the calculation of the index. We have from 2006 to 2016, and the highest, the index, it shows the highest difficulty that, or the highest number of sectors that face difficulty in generating cash flow to face debt commitments. So what disaggregate index of financial fragility, it considers this divergence between cash flow and debt commitments, and it means that an increase in the value of this index suggests a reduction in the payment capacity in relation to past commitments. So it is from 2010, this index is increasing, and it reached the highest level in 2003. So then, meaning that the industrial surplus was falling to face that commitments. Let's recall that, as I mentioned before, that you have a drop in the interest rates in 2011, but it started increasing again in 2012. So it dropped from 11.8% beginning of 2011, and reached 8.6 in 2012 and start increasing again. And it increased until 2016, and then start decreasing. And now in 2021, in pandemic, still we start increasing our interest rate again. So here's the distribution of the number of industrial sectors, and we follow a classification to consider when the average of the financial fragility of each sector could be classified as hedge, speculative, or Ponzi. And what's interesting to observe that in 2007, I have from 25 sectors, 16 would be classified as hedge in their, the firms in average were in a hedge position. And the number, it goes up to 2010. But when we move to 2013 and 2014 and 2015, that's the worst in our series, you see the decrease in the number of sectors with hedge position and increase the number of sectors with Ponzi position. Actually, the highest is 14 sectors where we had that, in average, the firms were compromising at least 90% of their cash flow, net cash flow, to face, 90% was committed of the cash flow to pay debt commitments and duties. So that was in 2015, and after that to start recuperating slowly. So that's to show the impact of the crisis in the investment for the industrial sector. So what we did next was an econometric exercise where we try to determine to explain which variables explain the behavior of the financial fragility of the industrial sectors. So here our hypothesis: the more the firm resorts to finance fixed assets expenditures to third-party resources via credits, the more it exposes its balance sheet to market vicissitudes. An increase in the interest rate increases that burden, and it aggravates the firm's financial fragility. And financial fragility has properties of persistence over time, as past debt commitments have to be honored with present cash flow or more credit. So we chose a dynamic panel, and we believe that is adequate just to check the temporal persistence of the financial fragility. Also, it deals with possible effects of simultaneity, measurement error, or specification of the empirical model. Also, a static fixed effect panel has been run. We run this with fixed effect as well. As a reference for two reasons: it shows the bias of neglect of the dynamic effect of financial fragility, and it strengthens the empirical nature of determinants of the financial fragility. So here's our equation. We have two blocks of variables, one that we call the sectorial vector. It is the first one. We have the investment rate of fixed capital, the share of wages in value added, and the share of financial income in total income, and what we call the macroeconomic vector, where we consider the ratio of credit outstanding in relation to the flow of investments in fixed assets, and J, that's the basic interest rate. So just the three estimators, I minimize possible source of endogeneity, determinants of financial fragility. So we have a static data estimator in panel with fixed effect, and we have the dynamic estimators. And the dynamic estimators, we have the GMM indifference, and the dynamic estimator systemic GME, that is GME size. So the dynamic estimators, we believe, more appropriate in the presence of the temporal persistence of the dependent variable. So here we run the the tests, the unit root tests, and the variables are non-stationary. In level, stationary the first difference at 1% significance. The tables are the numbers are very small. I'm just commenting what the conclusions are. The co-integration test, the Perrotini co-integration test confirms the alternative hypothesis of a co-integrate panel at 1% significance. And here I have also the results of the estimate. We run the three models, the fixed effect, the GMM GIF, and the GMM size. And so I'm going just to show what our conclusions about the results, that the hypothesis of temporal persistence of the financial fragility is identified in the GMM estimators. A bond autocorrelation Sagan over-identification test confirmed the hypothesis. The hypothesis that the change in economic policy and that we try to capture by this variable, the ratio credit to investment, that's the variable D, it is confirmed in the three empirical exercises at 1% significance. And also the hypothesis that an increase in the interest rate and an increase in the wages share, they have a positive impact on the financial fragility because they reduce the firm's cash availability. It was confirmed in the GMM GIF estimator, and the share of financial income and investment rate variables, they are significant in the GMM size estimator. So we were pleased with our results, mainly with this second item here, that we could capture the macroeconomic environment through this credit investment ratio variable. So summing up, the Brazilian economy was in an ascending phase of an investment cycle, when then it was hit by the international financial crisis. Then the new government that took office in 2011 changed the way macroeconomic policy had been conducted since 1999. And that attempt was made with good intention to turn more flexible the management of the macroeconomic tripod. So that's the reason why it was there were so many attempts to decrease the interest rate and to devaluate the exchange rate. But the main problem was perhaps the fiscal policy, because the incentives, they move from the aggregate demand to supply side incentives. And in a context, in a macroeconomic context, the prospects of growth were not so strong as they were in the 2000s, then the result of this change did not deliver what was expected. So the change did not improve the macroeconomic context. Inflation rates accelerate, government savings became negative, and current deficits increase. So inspired in INSC's financial fragility, now we estimate the index of financial fragility for industrial sectors, and the econometric exercise that showed that the coevolution of the industrial firm's financial fragility and the deterioration of the macroeconomic context via credit decoupling to sustain investment, fixed assets, fixed capital, and the shock in the interest rate in the first half of 2010. So in this sense, the paper sheds new light, we hope, to explain the reasons why the Brazilian economy has dove into a recession since 2015. While we do not recover investment, it will be very, very difficult to overcome this almost a depression, I believe, for this tension that of the low growth. The fiscal austerity that has been implemented from 2015 onwards, and the liberal reforms since 2016 did not deliver growth, and the Brazilian economy is stagnating. So just a few, I believe I can go a little bit longer, and just to show the results for now, non-financial firms, and the data from balance sheet from 2012 and 2019. So the idea, so we get this information from public trade firms, and the idea is to shed some light on how non-financial companies have reacted to the 2015-2016 recession, suggesting that the change in macroeconomic policy it contributed to, at first, weakening the balance sheet of the firms. But then the firms decide, the big ones, to restructure their balance sheet, taking advantage of the fact that interest rates start to decline and were very low levels until very recently. So no financial firms were very leveraged in the pre-recession period, and austerity policies did not recover the confidence and actually induced the firms to postpone investments. And of course, in doing this, they are contributing to depress aggregate demand. Just to show the correlation, the line is an index of the gross capital formation for national accounts, and the bars are the investment of the firms, of these large firms. So there are some correlation. And here is just the financial fragility index that's different from the other one, because here we have the data from the balance sheet. So it's a ratio between cash flow from profits, from operational profits and from financial applications, less the payment of interest rates and taxes, and this is related to the amortization of the firms. And then we have also a classification for hedge, speculative, and Ponzi. And here I have the distribution. So the top 100 non-financial firms from this period, 2012, 2019. And so the number of hedge, speculative, and Ponzi, and just to call attention that at 2012, 13, 14, you have over 50% of the big firms classified as hedge postures in their finance. And then from 2015 onwards, you see the number of Ponzi firms increasing. Of course, this number is not very low numbers, but let's consider that we are talking about the highest, the biggest firms in Brazil. So what we did next, that's the last thing I'm going to show, is that we made weights aggregate financial stability index. And so the interpretation is that close to zero, we have more Ponzi firms, and close to 100, we have more hedge firms. And so we draw this index with two definitions of cash flow. The bottom line shows the cash, considers the cash flow only profits, operational profits, and the top line considers in the cash flow the operational profits and the financial receipts also. So just to illustrate how firms rely on financial receipts to balance the balance sheet. If you consider only the operational profits, we would have much higher number of top firms in a Ponzi position. And from 2016 on, once interest rates start to decline, then we observe that the option of the firms was to restruct the balance sheet, changing old debts negotiated at higher interest rate for new debts at a lower interest rate, but not recuperating the investment. So my final consideration is that the stagnation of the Brazilian economy, the economy is stagnated actually. The economy's recovery and becomes slower, given that you have a lower weight of operation income in the composition of the firm's revenues, and the diverse range of financial assets available to the firms, they cause a kind of crowding out of productive investment. So they can keep the positive results without investing. So the response of the Brazilian economic policy has been, since 2015, to cut public spending and to adopt a fiscal austerity policy agenda. And unfortunately, this means it has gone in the opposite direction of sustaining aggregate demand to anchor Asian expectations, to stimulate productive investment and ultimately promote economic growth. So thank you. That's what I have prepared to present.
Thank you very much, Carmen, for such an interesting and inspiring presentation. To be sure, you have given us a paper, which, of course, as you mentioned towards the end of the presentation, sheds light for the explanation of the low resilience of the Brazilian economy after the financial crisis. And of course, I mean, there are many young scholars in the audience, and I'm sure many of them have found your presentation very inspiring and stimulating for their own research. So now I think we come to the Q&A part of the meeting. So if there are questions from the audience, please raise your hand and put forth your question. Please go ahead. Who wants to break the ice? Yes, Professor Benjamín, go ahead, please. Your mic is closed, please.
Yeah, just to break the ice, as you said, Professor Perrotini. Well, congratulations to Professor Feijo, because the presentation you have made according with the sort of consensus between macroeconomic bias economists in Mexico is just to answer the following analytical issue. Why the growth slowdown persisted during such a long period of time, and why macro policies have been so far unable to overcome that weaknesses, structural weaknesses in the economy. So congratulations for that on behalf of the field of knowledge of for economic development in our faculty, the Faculty of Economics of the UNAM, the National University of Mexico, as you very well know about that.
Yes.
I think the hypothesis, Minsky hypothesis, has taken you to very consistent, plausible conclusions for the Brazilian economy. So I like only to intellectually provoking you or trying to do that, asking you why you don't use apparently the three-gap model. The three-gap model is, I think, quite right to analyze the same variables you have managed in your research. And what advantage present this model, the three-gap model? The following: beside foreign exchange shortages, fiscal or investment constraints originating in and over indebted trap in our economies, really prevent Brazilian, the Argentinian, and the Mexican economy too from achieving a full capacity growth path. This is my question. I think are again quite plausible the results you got so far with your different methodology use, but I think it's quite fruitful. The three gaps model for economies such as Brazil, having reduced fiscal space, reduce public sector savings, so unable to foster the public investment in that economy. But you know, you obviously have preferred other methodology and you manage very well. But again, highly indebted countries and countries have faced, you know, hyperinflation. I think is a right way to make the research about how or why is a stagnating economy Brazil.
Okay.
Yeah.
So, Carmen, would you like to respond immediately, or you want me to collect more questions? How do you prefer?
Perhaps I can try to give an answer now, and then you can come back.
Okay.
To the,
all right. Okay.
Then people get preparing more questions.
That's right. Yeah. So please do so. Yes.
Yes. Yes. No. Thank you very much. Yes. You were right when you say that I chose this way to make a presentation because we have many interpretations of why the Brazilian economy is stagnating. But I have not seen much analysis exploiting this idea that you was on an investment cycle, an investment phase, a positive investment cycle in the 2000s, where the favorable domestic and external conditions allow that, and to help to understand the stagnation in the 2010, we should also, so I'd like to call attention also to the behavior of the investment. And actually, you have few studies exploiting the behavior of the investment. First, because you have lack of data. Perhaps now we are going to have more access to balance sheet data. And so that's why I try to exploit the investment. And then literature, the reference was Minsky business cycle. Actually, what we saw in Brazil was not a typical Minsky crisis, because you don't have actually liquidity crisis, but you have more investment being disappointed because you have a drop very sharp in aggregate demand, and the external sector blurring our prospects. Totally different from the 2000s. So that's what we try to highlight in this paper. But actually, I fully agree with the analysis of the policy space being reduced, about the foreign external constraints, and these are the traditional problems that our economies in Latin America we face. So all our effort is to discuss how we can increase our policy space, which sort of policies we should pursue to increase our policy space. And definitely, it's not, in my opinion, what you have been doing in Brazil. That's austerity and opening more the economy, what I believe is going to increase our external vulnerability. You should also consider that you have been deindustrializing very, very, very quickly. So now in 2020, 2021, the agriculture weighs more in GDP than industry. So we are back to the 40s before the industrialization. So definitely in my view, I believe this will reduce very much our capacity to grow. So actually, what I believe, I hope that to show that the importance of resuming investment and the role of public investment, because the main problem was in the 2011 change in macroeconomic policy, to cut investment, public investment, and in a context where the macroeconomic conditions have changed in relation to the 2000s. So the signal of the government policy should be to sustain public investment, but because of fiscal problems, they decide to cut public investment and to give this tax exemption, where it did not work as expected. On the other hand, you have this trend to financialization of the economy. You have many options to sustain income with gains from the financial sector. And that's another problem that should be tackled in order to deviate the resources to more productive investments. But that's another way of planning economic policy, to design economic policy, not the line on the direction that's being done nowadays.
Okay, okay. So now we have one more question from a student, Francisco. Please, Francisco, go ahead.
Thank you. My question is about the inflation targeted regimen. I am thinking that you have highlight some relationship between the inflation target and the investment cycle. Because I can appreciate that in your presentation, the inflation target has diminished, well, I'm thinking in that, the formation of capital formation is fixed capital, I'm thinking. So you think we must abandon the inflation target regimen, or we need to fix it? Or what are the possible economic measures that we must proceed to boost the growth of all economies, especially in Latin American economies, because we have a very deep problem of industrialization, or not even, or a problem of making to improve the industrialization of our economies. I might say that. Thank you.
Thank you, Francisco. Yes, Carmen.
Yes. Our problem with inflation target, I don't believe that we can abandon the inflation target. That's a question, but we can make it more flexible and coordinate better with other policies. I think the main problem is that when you rely only on one policy and one instrument to conduct the macroeconomic policy. And mainly in countries like Latin America countries, when you have a challenge besides using macroeconomic policy to control business cycle, but also you have to look at the transformation that you need in our productive structure in order that the economies can catch up, can raise the level of development of productivity, and definitely high real interest rates, as we have seen in Brazil for such a long time, it's quite discouraging of the investment in fixed capital. So we have a specific problem, I think, in Brazil. That's because inflation target has been conducted in a very conservative way. There are many reasons now why this happened, but I guess that it has to do with our past inflation history, and so that's why it has always been conducted in a very strict way and had this side effect of increasing, of appreciating our real exchange rates, and for such a long period that the industrialization was the result of this that's a negative combination, or that's that's vicious combination of high interest rate and appreciated real exchange rate. I believe that a way out should be to try to widen policy space using other instruments of macroeconomic policy, and to coordinate an industrial policy. Actually, it's interesting to call attention that there were attempts of designing industrial policies since mid-2000s, but totally not coordinated with the macroeconomic policies. So, so the results also were very, very precarious, because you had to now try to coordinate policies and not to, and definitely to control inflation, perhaps use other instruments also to control inflation, and not to rely only on the interest rates. And actually in Brazil, we had another problem. I don't know, I believe that's a specific of Brazil, that at least a quarter of our price index, that's the official price index that use as to set the inflation target, it is composed of administrative prices. So prices that do not move according to the movement of aggregate demand, which implies that you have to put higher interest rates in order, because the impact in order to meet your target is to, because 25% at least of your list of products and services, they do not respond to the demand. So actually, they do not respond to the instruments that you are using to control inflation. So that's something that's quite strange in our monetary policy. So you have many ways, I think, of turning more flexible the way of dealing with the monetary policy. But definitely it should change. But I would not say that would abandon, because I don't think we have space for that, but to use it more clever, have other objectives instead of only controlling prices, because the market will solve all the other problems. We know that it won't happen.
Okay, thank you, Carmen. So now we go across the Atlantic to collect a question from England by Aida Garcia. Please, Aida.
Thank you. Thank you, Carmen. It's very nice presentation. I really like how you develop the financial fragility index and the data you use. So I have two questions. When you explain the decline in investment after 2013, I understand the problem started with the global financial crisis, and then with the change in the macroeconomic policy from the demand to the supply type of policies. So, and then in the estimations that you present, one of the main variables is the interest rate. Right. So I was just wondering how much the international conditions matter, because in countries like Brazil and Mexico, the war interest rate affects the capital inflows, etc., and these factors. So how much it weighs, and how much is because of the domestic macroeconomic policies that I assume are more in the internal side? This is the first. And the second is in the other part of the analysis. that you mentioned about the fiscal policy. So is it only the expectations, which is not a small thing, right? But is it just the expectations that trigger the decline in further investment, or is there another direct channel that also cause that decline? Thank you.
Okay, thank you very much, Aida. Yes, to capture the international, some sort of international impact, we did not find it easy. We tried exchange rate, but did not work well in the model. So I guess that perhaps you have to rely on the interest rates, because as you mentioned, yes, interest rate is, the basic interest rate is set, also considering the flow of the capital flow. So you increase as you feel you need more to attract capital. Not only domestic conditions explain it. So perhaps you have some sort of influence, indirect influence through the interest rate. But indeed, we cross our mind to get other variables to capture the external impact. About the second part, as I understand, I believe that what happened is that it was very difficult to make a clear evaluation of what was happening in 2011 onwards, because Brazil had that very quick and positive response in 2010, when it recuperated very quickly the decrease in GDP in 2009. So this perhaps gave an idea that things would be, okay, it was just a small turmoil and we managed to be safe. But then you had the European situation, and then it blurred the idea of what was going to happen in the external front. Also, international trade start to decelerate, and the first attempt of that, what they call the new macroeconomic matrix, was to change the interest rate, but it did not work out because it decreased very quickly in 2011, start increasing again after 2012. So that might have given a difficult sign for the market of what was going to be the economic policy. And then this change, that was, I think, the worst problem, the biggest problem in the fiscal policy, because they changed the policy from the expanding, cutting public investment, but giving tax exemptions. And the expectation was that the private investment would catch up, but it did not happen. And the reason, I believe, my interpretation, is because expectations were then very bad. They were not as positive as they were in the 2000s. So too many things have happened, too many changes, not positive ones. And so to bet that private investment would take over if I give more space for them, cutting taxes, it would be the way, a good policy. But actually a good policy would have been perhaps to continue to invest, the public investment, to continue to be like a sign, so to coordinate expectations. I think it would be more positive than the way that it was followed. And then you have also political instability, and so things went the way they were. But another conclusion is that the austerity policy that they have been attempting, it's not delivering also any good result. So how long we're going to persist in this way? And that's our drama nowadays.
Okay, all right. So any further question? Jose Luis? Oh,
Yeah.
Jose Luis and then Tony, yes? Okay,
Okay.
go ahead, please.
Thank you very much. I found the presentation very interesting, and I have just a couple of questions. First, what was the role of the development banks in Brazil in spurring the investment in the 2020s, in the first part of the 2020s, and if they have been affected by the financial fragility? I mean, this financial fragility has affected these development banks? And the second question is, with this austerity policy that the government in Brazil has been implementing, has also affected the availability of credit by the development banks also?
Sorry, I did not get the second part. Can you repeat it? I did not.
Yes, I would like to know if the austerity policy implemented by the government has also affected the availability of credit in the development banks.
Yes, definitely, yes. Because it's not only the austerity policies, also liberal reforms, and development banks, they are not considered to be important, so they are shrinking. They were considered to be part of the deficit of the public deficit, so they had to return BNDES, return a large sum of money to the treasury, and so actually they are being dismantled. But that with this both, I think, is excuse the both justifications. One is that they are not needed, you see, and second is that because you have to repay the money that has been put in the development bank. So it's a very, very drastic change also in our traditional financial architecture, that we have all relied a great deal in the development banks, and we have also, every time we think first in the BNDES, that's the largest, the big one, but you have also regional banks, and they have local impacts for local developments. And also this is being dismantled, but because of the orientation that's total liberal, and so there is no role for development institutions, mainly development banks. So probably they won't have much role because they are being dismantled in the 2020s.
Okay, so I guess Professor Tony Thirlwall wants to raise a question. Am I wrong?
More than one question, Ignacio.
Oh, okay. Wonderful.
No, I mean, thank you very much for the most interesting paper. I think, you tell a very convincing story, but there's a couple of questions I would like to ask to get a better feel of what has been going on in the Brazilian economy. The first is, what proportion of investment in Brazil over the time period that you've been considering has been financed by bank borrowing or from And the second relates to the proportion of that are distributed or undistributed by Brazilian. One of the ways of coping with a cash flow problem may be to cut down the amount of profits that you distribute to shareholders and keep more profits for yourself in order to do the investment if you think the investment is desirable. But you see, I think that is the bottom line, that ultimately it's an accelerator theory of investment that you're talking about. And the financial fragility is in a way second. Because if there was the prospect of guaranteed income, so that investment, you would take advantage of the lower interest rate coming down over the period, and you would also have cut your dividends. And I can't remember what the econometric specification was. Do you have on the right-hand side the change in income? Do you control for the change in income, which would pick up an accelerator theory of investment? So you'd have the change in income, financial fragility, and the interest. Because otherwise, the financial fragility may just be picked up, the accelerator. Do you understand what I mean?
Actually, it was cut. The last part I could not. When you mentioned the econometric equation, the first two, I get some words. I try to figure out what I can reply. But so let me start with the first two, and then, because I think the connection is not, for me, is not so good. About actually the proportion, how firms invest, how they finance that investment. Actually, the traditional has been until the 2010 on retained profits. It's all statistics have been looking at. It shows, but then it started to change. And actually, firms rely more on credit to make investments. And also, we had always a very strong developing bank. So the BNDES also finance big investments. Probably they have public money. But also about what we realize is that what we see in the literature about the financialization of firms, it's not so clear in Brazil. I believe now, from the 2010s onwards, it's becoming more clear. And we could see, for instance, the payment of dividends when we look at that data research on the balance sheet of the firms, of the largest firms, that from 2015 on, they pay dividends even with a decline in profits. So, because those are firms that they are in the stock markets. But I don't believe that is a very common strategy of the firms. Our stock market is still very small, and perhaps that's the intention of the government, that it increases with time. but most the firms, they have more conservative ways of financing their investment or relying on public funds. So I would say that. That's why I put so I see the emphasis on expectations. I've been looking more at the point about expectations. So firms are very conservative because we have very limited credit availability for longer period of time. Credit is very short term, given by the private sector. Long-term credit has to be from public sector, from public banks. I don't know if I got more or less what you are asking.
No, you've answered my question. But some countries, they tax distributed profits more than undistributed profits as a way of trying to encourage firms to invest their profits. Was there ever a debate? Has there been a debate about this in Brazil?
Yes, it is about taxation of profits. Yes, I don't think we tax very high the profits. No. Now they are trying to increase the profits in banks. Very recently, I've seen that they are discussing to raise profits in banks, but not on profits on firms. And also, they do not tax dividends payments. So that's another characteristic of our fiscal regulations. So I would say that's kind generous law concerning fiscal rules, fiscal taxes, so taxation.
Okay, all right. I
believe he wants to.
Yeah, well, just my point about testing the accelerator theory of investment. We did not do that. You mean a model with the accelerator? No, we did a very simple, just to test the determinants of the financial fragility. No, but you presented an equation where you had investment on the left-hand side.
Yes.
Where the financial fragility mattered. What I'm trying to argue is that maybe just a proxy.
No, investment was on the right side.
Yeah.
Not on the left side. The left side was the financial fragility.
So you don't test an investment equation.
No, I did not. Not in this paper. Try in another one, but not in this one.
But, I mean, that would be the obvious thing to do, wouldn't it? To have investment on the left-hand side, test the competing theories about accelerator, financial fragility, and interest rate.
No, yes, I see it. No, that was not our strategy. We kept only on the fragility, on the financial fragility. We define a financial fragility index, and that's what we try to explain it.
Okay. All right, so let's move on. And then now we have a question from Francisco Martinez. Please, Francisco.
Thank you, Professor Ignacio. Professor Carmen, very nice presentation. Thank you for it. In the first period that you mentioned from the 2000s, I remember many people talk about profit squeezing, and because of the increase in real wages. So my question is, could you say something about the wages, the story of wages, the trend of the wages during this second half that you described, I mean, from the 2008 onwards?
Yes, yes. Indeed, you have an increase in the wage share, and that was for the first time, and there was a policy to increase the real minimum wage, and that has consequences in the whole range of wage, the average wage increased. Yes, and perhaps what happened is that at the same time, you had overvaluation of the exchange rate. So probably firms could compensate the pressure in raising wages with decreasing the cost of inputs and of import inputs. And that was also a stimulus for you to import. And that's one of the reasons why you deindustrialized the country. So I would say that probably what you try to compensate is the increase in wages with the overvaluation of the exchange rate, and so keeping down the cost of imports, of inputs for in the productive structure. I think we could and that's why was a way that you could combine a policy of increasing wages, but then you have a consequence, a negative consequence, that productivity did not improve. So, and then you lose competitiveness as well. So you lose twice. You lose with the exchange rate and also the increase in wages. So Brazil, so that's why Brazil is going back to the comparative advantages, and so that's why our deindustrialization is so deep.
And quick, it seems.
So on the other hand, if you improve the wages, you could expand domestic markets, but also you have this, you lose markets, external and domestic, with the exchange rate. So actually, we're back to the question about the macroeconomic policy. Then you keep a very high interest rate. The interest rate attracts capital. We appreciate the exchange rate. And the exchange rate, it compensates costs, wage costs, for instance, but then you lose market.
But the cause, or what is provoking inflation in these last 10 years is no wages, not like the last time, that in the period of the 2000s. I remember that many people mentioned that where wages push inflation, but now, this is another question that is related to the other question. What is the main trigger of inflation in Brazil? You can say some specific ones, or are wages, or are other things, or the other factors?
I think it's exchange rate. Exchange rate. The main transmission channel of monetary policy is definitely exchange rate. So if you devaluate, then inflation goes up. And if you appreciate, so we are kind of, that's our trap, that trap of inflation and exchange rate. And that's why it's so difficult to keep interest rates low. We starting, as I show in the in a graph decreasing the real exchange rate. But then there was a discussion, is that sustainable? And definitely it's not sustainable. So we are increasing exchange interest rate now in 2021, and we still are we have not recovered actually from the recession, the pandemic.
Okay. Thank you.
So,
okay. All right. So before the time betrays us, let me thank Professor Carmen Feijo for such an enlightening, illuminating presentation. So Carmen, let me tell you that at the peak you addressed over 70 colleagues, both students and professors who were around in your presentation. And I think this is a very stimulating topic. And of course, your paper will be published in Investigación Económica in the next issue, which is about to appear. And I'm sure many people will be looking at it, and then we'll gather inspiration for that. So I was just wondering whether it is possible, I mean, not for this paper, of course, and not for this conference, to be sure, but you show us that a number of firms, and you mentioned the largest ones, which are in a sort of Ponzi scheme, Ponzi situation. And I was wondering how many of these firms could be dubbed as zombie firms. I mean, how many of these firms are in a situation which of no return to either speculative or hedge scheme, if they are, you know, really deep in troubles financially speaking. So, for instance, in the United States, and I just finished a paper dealing with the U.S. economy, and I found more or less the same situation. It's not just Latin America; it's almost all over the world. The problem, I mean, the debt problem. So, and in the United States, they say that there are about 15 to 20% of highly indebted firms that can be called zombie firms, meaning that they are in a very difficult situation and that they might not recover from the financial fragility. So I mean, the same situation is true for the countries such as Italy, and I mean, you name it. I mean, it's I think the financial fragility that the pandemic sprung is perhaps as bad and as spread as the COVID-19 itself. I mean, it's everywhere. So many countries are on the verge of bankrupt or in a very difficult situation. And what you presented to us today also applies for the case of Mexico. I mean, mutatis mutandis, if you just change, you know, some numbers here and there, and of course the title of the paper, the same could be said of Mexico. I mean, we have fiscal austerity, we have a problem of financial fragility in the real sector of the economy, we have high unemployment, we have, I mean, the economy is stagnant, and so on and so forth. So I think we have attended a very interesting conference, a very interesting topic. And I'm sure many of the attendees will be inspired by your presentation. So I just want to thank you, Carmen, for being with us, for having accepted to contribute to this double celebration of the wonderful contributions of Tony Thirlwall to development economics and to the 80th anniversary of Investigación Económica. So thank you very much for being with us. And just for the audience, please don't go anywhere. Stick around. Next week, we have the last conference in this seminar. So I'll see you next week. And thank you very much for being with us today. Bye-bye.
oh, okay, thank you.
Gracias, profesor Perrotini.
Bye.
Bye.
Adeu, adeu, Carmen. Obrigado, obrigado, muito obrigado.
Muito
Obrigada,
obrigado.
Obrigado.
Sim.
Thank you very much. Tosanana. Thank you.
Thank you.